After studying this module, you shall be able to classify the accounts, know the golden rules of accounting, know the meaning of journal and journalizing, learn the steps in journalizing, learn simple and compound journal entries, know the treatment of special transactions. The basic function of accounting is recording. This recording phase should be accomplished in a systematic manner, as the whole process of accounting and its end results depend upon the first phase. Under traditional approach, the transactions and events are analyzed in terms of accounts involved giving suitable account headings. The accounts are classified as personal, real and nominal types, having distinct related rules. The accounts are debited or credited on the basis of their nature and corresponding rules of accounting. This module discusses the journalization process and the treatment of special transactions. Coming on to the classification of accounts, there are three types of accounts maintained by a business organization. That is personal, real and nominal. And out of these accounts, real and nominal accounts comes under impersonal account. The accounts can be defined as personal accounts. These accounts relate to persons, that is individuals, firms, companies, debtors, creditors, etc. The main purpose of preparation of personal account is to ascertain the balance due to or from persons. These accounts can be classified into three categories. A. Natural personal account. These are the accounts of natural persons, that is human beings like Ram, Shyam, Radha, etc. B. Artificial personal accounts. These are persons having their existence in the eyes of law, like corporate bodies or institutions, companies, clubs, etc. C. Representative personal accounts. These are the accounts which are not in the name of any person or organization, but are represented as personal accounts. For example, if wages are due to workers, an outstanding wages account will be opened in the books. This outstanding account represents the amount payable to workers. Real accounts. These accounts relate to tangible and intangible assets of the firm. For example, the accounts like land, building, investment, fixed deposits, plant and machinery, stock, cash in hand, etc. Nominal accounts. These accounts relate to expenses, losses, incomes and gains. The examples are salary account, interest paid account, royalty account, commission received amount, etc. At the end of the year, nominal accounts are not balanced, as these are transferred to profit and loss account. That is why these are called as temporary accounts. The illustration for this is like illustration 1. Classify the following accounts according to the traditional approach: capital, cash, salaries, wages, outstanding wages, prepaid salaries, discount received, bank account, furniture and fixture, commission received, light, power and electricity, drawings, debtor, loan from Mohan, a society, stock or inventories, machinery, conveyance charges, doubtful debts and bad debts. Now, doing the classification of these accounts as capital account will be classified as personal account. Cash account will be classified as real account. Salaries account will be classified as nominal account. Wages account will be classified as nominal account. Outstanding wages account will be classified as personal account. Prepaid salaries account will be classified as personal account. Discount received account will be classified as personal account. Bank account will be classified as personal account. Furniture and fixture account will be classified as real account. Commission received account will be classified as nominal account. Light, power and electricity account will be classified as nominal account. Drawings account will be classified as personal account. Debtor account will be classified as personal account. Loan from Mohan account will be classified as personal account. A society account will be classified as personal account. Stock or inventories account will be classified as real account. Machinery account will be classified as real account. Conveyance charges will be classified as nominal account. Doubtful debts will be classified as personal account. Bad debts will be classified as nominal account. As it can be seen that all the three types of accounts have separate and unique rules of accounting. Each account has two rules, one related to debit and other related to credit. These rules are called as golden rules of accounting, as the entries are recorded on the basis of these rules, and it forms the basis of double entry bookkeeping system. The three golden rules of accounting are: rule for personal accounts, debit the receiver and credit the giver. Rule for real accounts, debit what comes in and credit what goes out. Rule for nominal accounts, debit all expenses and losses and credit all incomes and gains. The steps for journalization are as follows. Step 1. Find out the accounts involved and their respective nature. Step 2. Ascertain the rule of debit and credit applicable for each of the accounts involved. Step 3. Decide whether the account to be debited or credited as per rule ascertained in above step. Step 4. Pass the journal entry in standard format in journal. Now, understanding journalization through the illustration as illustration 2. Decide the accounts to be debited or credited in respect of following transactions. A. Shiv started business with cash. B. Purchased furniture for cash. C. Goods purchased for cash. D. Salary paid. E. sold goods for cash. F. Paid commission in cash. G. Interest allowed by bank. H. Paid installment of loan. I. Withdrew cash from bank for office use. Thus, classifying the accounts of following transactions as: A. Shiv started business with cash. In this, cash and capital accounts are involved, out of which cash is a real account and capital is a personal account. In this case, cash is coming in, so it will be debited, whereas Shiv is a giver, so it will be credited. B. Purchased furniture for cash. In this case, furniture and cash account are involved, out of which furniture and cash both are real account. In this case, furniture is coming in, so it will be debited, whereas cash is going out, so it will be credited. C. Goods purchased for cash. In this, purchases and cash account are involved, out of which purchases is a nominal account and cash is a real account. In this case, goods are coming in, so it will be debited, and cash is going out, so it will be credited. D. Salary paid. In this case, salary and capital account are involved, out of which salary is a nominal account and capital is a personal account. In this case, salary is an expense, so it will be debited, and Shiv is the giver, so it will be credited. E. Sold goods for cash. In this case, cash and sales account are involved, out of which cash is a real account and sales account is a nominal account. So cash is coming in through sales, so it is recorded as debit, and goods are going out, so it will be credited. F. Paid commission in cash. In this case, commission account and cash account are involved, out of which commission is a nominal account and cash is a real account. Thus, commission is an expense, so it will be debited, and cash is coming in, so it will be credited. Interest allowed by bank. In this case, cash account and capital account are involved, out of which cash is a real account and capital is a personal capital. So in this case, cash is coming in, so it will be debited, and Shiv is a giver, so it will be credited. H. Paid installment of loan. In this case, cash account and capital account are involved, out of which cash is a real account and capital is a personal account. So in this case, cash is coming in, so it will be debited, and Shiv is the giver, so it will be credited. I. Withdrew cash from bank for office use. In this case, cash and capital account are involved, out of which cash is a real account and capital is a personal account. So in this case, cash is coming in, so it will be debited, and Shiv is a giver, so it will be credited. Now next, we will talk about the journal. The business transactions are recorded in the books of account. Journal is the primary book of accounts, where the transactions are first recorded in a chronological order. They are recorded from the accounting vouchers, which are in turn prepared from source documents like cash memo, invoices, purchase bills, etc. Moreover, it is clear that journal is the part of the very first phase of accounting in which the transactions are incorporated in accordance with time, duly identifying the accounts involved and also the debit and credit aspects. Next, we will talk about the features of journal. The transactions are recorded in the sequence of their occurrence. It is book of original entry in which transactions are written before any further accounting treatment. It is a part of double entry system of bookkeeping. The entries are recorded in such a manner that it incorporates the complete transaction. The advantages of journal are as follows. It provides a chronological record of all transactions. It reduces the possibility of error of omission as the transactions are recorded immediately. It provides the basis for classification and preparation of ledger accounts. Now, the format of journal can be explained. Column 1 is date. This column incorporates the date of transaction. Column 2 is particulars. This column gives the two aspects of transactions, duly giving the name of the accounts to be debited or credited. A brief description of the transaction is also given in the form of statement called as narration. Column 3 is LF. It stands for ledger folio. This shows the page number of the ledger to which the amount is posted, where the corresponding account appears. Column 4 is debit amount. In this column, the amount debited is written. Column 5 is credit amount. In this column, the amount credited is written. It can be studied that there are two types of journal entries. Simple journal entry. It is a usual entry wherein only two accounts are affected. That is, one account is debited and another account is credited with an equal amount. For example, when machinery is purchased for cash, then in journal entry, machinery account will be debited and cash account will be credited. It is an example of simple entry. Say machinery account debited 15,000 to the credit of cash account 15,000. Compound journal entry. It is an entry in which two or more accounts are debited and one or more accounts are credited or vice versa. When transactions of similar nature take place on the same date, they may be combined while they are journalized. For example, a debt of rupees 10,000 due from Mukesh, debtor, has been discharged by receipt of rupees 9,600 in cash and rupees 400 allowed as discount. We can pass the following entry. Cash account debited 9,600, discount account debited 400 to the credit of Mukesh account 10,000. Now we will talk about some of the special transactions. Drawings in cash. Drawings refer to the amount of cash withdrawn by the proprietor for personal use. It may also be in kind. The usual entry to be passed is to debit the amount to drawings account. It may be noted that it is a temporary account which is ultimately transferred to capital account. Drawing account debited to credit of cash account, being cash withdrawn for personal use. Another such transaction is bad debts. In a business, the goods are also sold on credit basis. The amount to be recovered from such customers is recorded as debtors. If this amount is not realized or is partially realized, the unrecovered amount is called as bad debts. It is definitely a loss for the firm. The following journal entries are passed in this regard. When the amount is not recovered, bad debt accounts are debited to the credit of debtor's personal account, being the amount not recoverable written off as bad debt. When a part of debt is not recovered, cash or bank account is debited, bad debt accounts debited to the credit of debtor's personal account, being the amount received, and balance written off as bad debt not recoverable. Next is bad debts recovered. In this, the unrecovered amount is debited to bad debt account. Sometimes a debtor whose account has been written off earlier as bad debt pays some amount. This recovery is called as bad debts recovered. In the year of recovery, it is a gain to the business. The entry to be passed is cash account debit to the credit of bad debt recovered account, being recovery of amount earlier written off as bad debt. These special transactions can be explained better through illustrations as Illustration 3. Journalize the following transactions. A. Rakesh, who owed rupees 12,000, is declared as insolvent. A dividend of 40 paisa in a rupee is received in full and final settlement. Received rupees 2,500 from a debtor whose account has been earlier written off as bad debt. Thus, in this case, in part A, Rakesh, who owed rupees 12,000, is declared as insolvent. A dividend of 40 paisa in a rupee is received in full and final settlement. This entry to this is as cash account and bad debt account debited with 4,800 and 7,200 respectively. And Rakesh account credited by rupees 12,000. Because in this case 4,800 has been recovered from the bad debt. In part B, received rupees 2,500 from a debtor whose account has been earlier written off as bad debt. In this case, cash account is debited with rupees 2,500 and bad debts recovered account will be credited with rupees 2,500. Because in this case, cash has been received through the recovery of bad debts. Now, the another special transaction is special transactions relating to goods. The usual outflow of goods may be in the form of sales or purchase return. But there are few special transactions wherein there is outflow of goods, but it is neither sales nor purchase return. The following are the relevant points. It is debited to relevant account. For example, goods given for charity should be debited to charity account. The purchase account is credited. It is always recorded at cost. Now, the following illustration explains these special transactions relating to goods. Illustration 4. Journalize the following transactions in the books of Mr. Nikhil. A. Goods costing rupees 1200 given as charity. Sale price rupees 1800. B. Goods destroyed by fire. Sale price rupees 5000. Costing rupees 4000. C. Goods withdrawn for personal use. Sale price 6000. Cost rupees 4500. D. Goods costing rupees 2000 distributed as free sample. E. Goods used in furnishing the office costing rupees 4000. F. Goods costing rupees 2500 stolen in transit. The journal entries can be passed as A. Goods costing rupees 1200 given as charity. Sale price rupees 1800. The entry will be charity account debited by 1200 rupees to purchases account as the goods has been distributed as charity. B. Goods destroyed by fire. Sale price rupees 5000, costing rupees 4000. The entry will be loss due to fire account debited by 4000 rupees to purchases account credited as the goods have been destroyed by fire. C. Goods withdrawn for personal use. Sale price 6000, cost rupees 4500. The entry will be drawings account debited by 4500 rupees to purchases account as the goods are withdrawn for personal use. D. Goods costing rupees 2000 distributed as free sample. The entry will be free sample account debited by 2000 rupees to purchases account as the goods has been distributed as free sample. E. Goods used in furnishing the office costing rupees 4000. The entry will be furniture account debited by 4000 rupees to purchases account as the goods has been used for furnishing the office. F. Goods costing rupees 2500 stolen in transit. The entry will be loss in transit account debited by 2500 rupees to purchases account as the goods have been stolen in transit. Now, the another special transaction is purchase and sale of fixed assets. When business purchases the item in which it deals in ordinary course of business, it is treated as goods. Fixed assets include things like machinery, building, motor car, furniture, etc. When fixed asset is purchased, the asset account is debited individually. It is not debited to purchases account because the business has not purchased it for sale. Similarly, when any fixed asset is sold, it is not credited to sales account, rather respective asset account is credited. The following are relevant entries. When asset is purchased on cash basis, asset account debited to credit of cash or bank account, being the asset purchased on cash basis. When asset is purchased on credit, asset account debited to credit of vendor's account, being the asset purchased on cash basis. When asset is sold on cash basis, at the time of sale, profit or loss on such sale is calculated by the comparison of written down value and sales price. In case sale price exceeds the book value, it is a profit and to be recorded in the following manner. Cash or bank account is debited to credit of asset account to credit of profit or sale of asset account, being the asset sold on cash basis. If sale price is less than book value, it is a loss, to be recorded as follows. Cash or bank account debited, loss on sale of asset account debited to the credit of asset account, being the asset sold on cash basis. When asset is sold on credit basis, if asset is sold on credit, same entries will be passed as above, with the exception that cash bank will be replaced by vendor's account. The next type of transaction is discount. It is basically a reduction in amount which may be in the nature of trade or cash discount. Trade discount. In order to promote the sales or as a trade practice, a reduction is allowed by the seller from the list price. This reduction is called as trade discount. Although it is reflected in invoice, but it is not disclosed in the books of account, and as such, no trade discount account is opened. No journal entry is required. Cash discount. In order to encourage the buyer to make prompt payment in cash, a reduction is granted from the invoice price called as cash discount. It is calculated on the net amount. In accounting books, cash discount account is opened. Now, some of the points to be noted are: 1. Cash discount is allowed when payment is received, and cash discount is received when payment is made. Discount allowed account is debited and cash discount received account is credited. If both trade and cash discount are allowed, trade discount is allowed first and thereafter cash discount is allowed. Illustration 5. Pass the journal entries for the following transactions. A. Purchase goods for cash from Sanjay with MRP of Rs 20,000 at terms 10% trade discount. B. Goods purchased for cash having list price Rs 40,000 at 10% trade and 5% cash discount. C. Sold goods to Raja for cash for Rs 25,000, allowed him trade discount 20% and 5% cash discount. Received the total due amount by check. D. Sold goods for cash for Rs 50,000, allowed him trade discount 10% and 5% cash discount. Half of the amount was received in cash immediately. The entries to these transactions can be passed as A. Purchased goods for cash from Sanjay with MRP of Rs 20,000 at terms 10% trade discount. The entry would be purchases account debited to cash account by 18,000 rupees. B. Goods purchased for cash having list price Rs 40,000 at 10% trade and 5% cash discount. The entry to this transaction will be purchases account debited by 36,000 rupees and cash account and discount received account to be credited by 34,200 rupees and 1,800 rupees respectively. C. Sold goods to Raja for cash for Rs 25,000, allowed him trade discount 20% and 5% cash discount. Received the total due amount by check. The entry to this will be bank account debited by 19,000 rupees, discount allowed account debited by 1,000 rupees and sales account to be credited by 20,000 rupees. D. Sold goods for cash for Rs 50,000, allowed him trade discount 10% and 5% cash discount. Half of the amount was received in cash immediately. The entry to this transaction will be debtors account, cash account and discount allowed account debited by 22,500, 21,375 and 1,125 rupees respectively to sales account credited by 45,000 rupees. The last kind of special transaction is expenses. The following are the important points. Sundry expenses. A business may incur petty expenses like postage, conveyance, miscellaneous expenses, etc. These expenses are normally debited to single account, that is, sundry expenses. The following is the usual entry. Sundry expenses account debited to the credit of cash account, being miscellaneous expenses incurred. Outstanding expenses. These refer to those expenses which are related to the current year but have not been paid till year end. These are accounted as outstanding expenses if the accounts are prepared on accrual basis. For example, salaries for the current year amounting to Rs 1,20,000, out of which Rs 5,000 has not been paid. The adjustment entry for this outstanding rupees 5,000 would be salaries account debited 5,000 to outstanding salaries account credited 5,000. Being the outstanding salaries accounted. Prepaid expenses. These are expenses like insurance premium, rent of the shop, etc. and are paid in advance. It means a portion of benefit would be received in next period. These are called as prepaid expenses. For example, the portion of insurance premium that pertains with the next year will be accounted as follows. Prepaid insurance premium account debited to the credit of insurance premium account, being amount transferred to prepaid insurance premium account. Thus, the whole can be summarized as the basic function of accounting is recording. There are three types of accounts maintained by a business organization, namely personal, real, and nominal accounts. All the three types of accounts have separate and unique rules of accounting. These rules are called as golden rules of accounting. The rule for personal accounts is debit the receiver and credit the giver. The rule for real accounts is debit what comes in and credit what goes out. Debit all expenses and losses and credit all incomes and gains is used for nominal accounts. The process of recording a business transaction is called as journalizing. Journal is the primary book of accounts where the transactions are first recorded in a chronological order. In order to promote the sales or as a trade practice, a reduction is allowed by the seller from the list price called as trade discount. In order to encourage the buyer to make prompt payment in cash, a reduction is granted from the invoice price called as cash discount.